Good afternoon, everyone. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services. And here we are on this Valentine's Day edition of the weekly wrap-up. Graham, much like some of our relationships out there, this weekend or this past week has been a roller coaster in the market. What can you tell us about that?
Yeah, you're right. Hopefully it ends on the positive side, right? Instead of the negative side. Didn't quite go that way the last week, Stacy. A couple of things, obviously, high on the headlines. High inflation. I mean, the print came out at 7.5%. We just left 7% on the last report. Geopolitical tensions really rising with potentially Russia invading Ukraine and what pressure that might be putting on the commodities, oil, natural gas, so on and so forth. Also what we really saw is kind of an interesting little dichotomy in the market. Actually, we saw small cap stocks actually up 1% with value, where we saw technology pull back. So we saw the NASDAQ and the S&P off about 1 to couple percent, in technology, that certain sector down about 2 to 3%. So still seeing that risk off trade flowing over to what generally, or at least has been some areas that have outperformed in the past, and that would be like commodities. So let's say like oil, possibly with banks with rising interest rate and the potential of net interest margins improving for banks, so on and so forth. So those sides of the market have stabilized, increased, where you've still seen the high growth, high speculation side of the market, continue to struggle quite a bit.
Okay, well, do we think that this protracted period of high inflation, do we think so?
As I've talked before, I don't think it's really transitory. And I hate to even use that term before, right? Term again. I don't think it's as transitory. Certainly, it has an opportunity to moderate a bit. But I think we could easily be going through a protracted period of higher interest rates. I mentioned that on our previous calls. So I think you have to be prepared. You have to be more mindful of where you're investing, where you traditionally might have had more bond exposure, maybe long-term bond exposure, maybe shorten those exposures up a little bit. Maybe you focus a little more on areas like commodities, maybe the oils or banks or things that might be buoyed or at least have the opportunity to outperform in a rising interest rate environment with the geopolitical tensions going on out there. I think we just have to be a bit more mindful, because I don't think that inflation is going to come down anywhere as fast and as quick as originally thought. And again, like I said before, it's not about interest rates going up, because that's not necessarily a bad thing, right? Think about it. When you're raising interest rate, it's a vote of confidence for the economy. But it's the pace of those interest rates, which is what is spooking the market. So again, let's take our short-term hat off. Let's put our long-term hat on, kind of ride it out a bit. Make sure you own high-quality investments in a structured, organized plan. And I think we should sail right through this. But it's going to be a little rocky seas for a little bit.
Well, you mentioned the geopolitical events. So what do you think we can expect if Russia is to invade the Ukraine?
Well, I think you're going to have possibly another big drop in the market. I hate that. And no one likes to have that. And there's certainly no crystal ball. I don't have any unique knowledge on this. But 5-10%, and that would honestly probably take us back to retracing the intraday lows that we saw a couple weeks back on the indices, where the NASDAQ was down around almost 20%, 10+% on the Dow and the S&P. The small caps, Russell small caps, man, they've been down in a bear market for quite a while. So we could easily retest, possibly break, which would open, at least from a technical standpoint, to go down even further before we could start to set a base. But now that I've kind of painted a bleak picture, let me give you some light at the end of the tunnel. Okay. One thing we like to look at is sentiment numbers. And think about it this way: when everyone's very pessimistic or very optimistic, your mind, at least in your planning, in your portfolio, might want to start shifting to the other side. So let's think about this. When people are very pessimistic, maybe we want to start thinking about okay, maybe we're closer to a bottoming pattern. Maybe not at a bottom, but maybe we're starting to set some bottoms and we're churning around here on the indices that maybe we can build off of, right? So kind of the opposite of what you might think. When people are overly optimistic, maybe you want to start setting in some safety in the account to protect against pullbacks, so on and so forth. We are showing extremely pessimistic numbers, which in my book would cue us in to say, hey, we possibly could, I'm not saying we are, but we possibly could be churning around in a bottoming pattern, right? Might not be at the bottom, but churning around that bottoming pattern that could set us up for gains down the road.
Well, it seems like that's what's happened historically, at least. So we have that information in our back pocket. Thank you so much, Graham, for this information. And thanks to our viewers for joining us today. And just a little reminder, we have another Retirement Planning Today class coming up in March. So we're going to have that information posted on our website and on our social media accounts very soon. So if you are in the market, please check that out or pass that information along to someone who is. Hope everybody has a great week, and we'll see you next week.
Happy Valentine's.
Happy Valentine's. Bye-bye.